Hey Bucks, I'm making a new video series about my investing thesis. It's going to be about demographics, population, job growth, policy reactions, and how these factors influence my thinking. So today I'm going to talk about my long-term view on jobs and income growth in America. So instead of throwing stats and graphs at you, let me tell you a story. You probably know that 70% of the GDP is on spending. Now, do you know that the peak spending age is 35? So typically, families will have to spend on children, cars, houses, and they're usually further along in their career and make decent wage. Now, the boomer peak spending has long passed. The youngest Gen X already passed 40. So the millennials are just starting to go through that phase right now. So that's the positive sign for the economy, right? So for the millennial, it's nowhere near the parent spending power. They're already overburdened with student debts and that they had gone through two recessions in their early careers. And those are crucial years for the career development and really set them back. So when you think it can't get any worse for the millennials, the Fed keeps lowering interest rate and prop up asset prices to save the boomer's nest egg, and you can't let the price to fall, right? So the price of everything went up: healthcare, education, and real estate. It's making life a lot harder for the millennials. So the only logical decisions is to have less kids. And that's happening all over developed nations, Europe, Japan, China. And it's happening in America. So we're seeing the rise of technology, WTO, U.S. workers have to compete with overseas workers and AIs and robotics. So no wonder our wages don't go up. So the millennials have the worst financial prospect than the previous two generations. Now, and then COVID happened. Economy was shut down. We're 2 years into it, and the employment level is still not the same, quite not fully recovered. Just this week, we had a really disappointing job numbers, and it spooked the market. Not to mention a new wave of Omicron. Yes, there's record number of job openings, but why aren't people going back to work? And there are many reasons. Some families, don't have access to childcare. Some people, have to look after the family with members with long COVID symptoms or suffering from COVID, or some may change their spending habit so they can sustain on only one income. On top of that, we receive a lot of pandemic assistance from the government, from mortgage forbearance, eviction moratorium, child tax credit. People are seeing the savings account going up. So that's why people are not rushing back to work. Then there are people who have also full-time trading stocks and cryptos, and they're doing quite well. So net worth going up. So they don't want to, don't want to just go back and work. Whatever the case might be, the long-term trend is that boomers are retiring from the workforce, and COVID just kicked in high gear. While unemployment rate has came down, we have a record low number of labor force participation rate. So what's the cure? Right, you guessed it. It's higher wages. Yes, that means wages could continue to rise in the near term before we get to a new equilibrium. I think software and automation will eventually put downward pressure on wage growth, and many businesses may not be able to afford the higher wages. Regardless, there will be less people working now than before COVID started. But now, let me bring it all home. Right? How do you use this information in your investing? If you're a real estate investor with a short to medium term horizon, let's say 3 to 5, 10 years, your job can be surprisingly simple. You just have to follow the long-term demographics and job growth trends in your own submarket, since real estate is hyperlocal. Even though your state might be experiencing job losses, you might still be able to invest in a submarket with jobs. I got a phone. Hold on. Strong. You can still invest in the stock market that with really good job growth. So I'll write about the stock market in Washington State as a demo, and you can read about it when you subscribe to a newsletter on sharpeinvestorgroup.com. In the next year, wage inflation should be sticky, and it is great for real estate because you can raise the rent while you can keep your mortgage low. So investing in equity might be a little tricky because high wages could erode profits. Depending on the product, how reliant on labors and how defensible is the margin, some business may not be able to, pass it on to the consumer and have to eat the cost. So that's it, folks. Hope you like our video, and if you want to me to make more videos, please subscribe to our channel. Thanks.
The editor here, please like and subscribe. It really helps out.